We've all heard the famous saying, the trend is your friend. Trade with momentum, trade with market structure, because they say higher time frame equals more confidence, more reliable, and less noise. Well, what I can tell you is that it's more important to catch the most probable portion of a move, not the entire move itself. So whether you are trading pro trend or counter trend, it's not so important because you're not going from the lowest point to the highest point of the market. You're going for the most probable portion. And with all the proof that I've shown on this channel with case study after case study, a lot of those trades were actually counter trend positions. So contrary to popular belief, counter trend trading can give wonderful opportunities because it moves a little bit slower, gives a little bit more retracements and confirmations, and becomes a lot easier to navigate than pro trend scenarios, because pro trend scenarios everybody knows about, therefore it's more likely to get induced, move a lot faster and harder to read, and maybe doesn't even come back for an entry. So here's a complete guide on how to effectively counter trend trade with high probability setups, reliable frameworks, and a complete blueprint on the step-by-step process of this strategy, showing you the pros and cons, how to implement it, and also chart examples show it in action. So getting right into it, on the screen we can obviously see we have a bullish trend from this low in the market, making a higher high. This area fails to make a low, so it's a higher low. This area doesn't make a higher high yet, retraces a bit, goes on to make a higher high. So we have two very clear bullish expansions, and therefore we know the associated break of structure points. But here we have our bullish market structure, and associated with that, now that we know our main pushes, we can define our ranges. And therefore we can see from the initial main push, we had from the low, the external low, to this high in the market, that was the external high. Then we had this internal price action that is a retracement. This is inside of our purple lines, the external high and external low. And then when we see impulse number 2 from this higher low that breaks structure and forms this higher high, now we've had a new main push in the market. So then the external high changes to here, and the external low is now moved to the next higher low. So we've now found a new main push in the market, impulse number 2, and we have the perimeters of it, which is the external low that made the new main push higher high. Therefore, that is a bullish expansion. We have now found the new main push with the external high and external low. And within here, when we track internal structure, we can see we have this internal high over here that forms this internal higher low. When we look at internal structure, we got to pay attention here because we do have internal price action within this trend. So this first initial high in the market, and this forms the internal high of the range. And then over here, we have a low. That's our internal low of the range. And when we see that these areas go on to get broken and form a new high in the market, so you can start to see as the new internal bullish high and higher low forms, we form a new internal high and internal low. And then when this goes on to form a new high, then we shift our internal range higher. And then when the higher low is formed respecting the previous internal low, then we have a new internal low forming. And then when this is broken once again, we can see over here. So at this point, this is where things get interesting, because now we start to see that this last higher low in the market goes on to form our internal low, break the internal high, break the external high, and overall break of structure, because it's breaking the previous higher high in the markets from the external range. So when this internal higher low, the internal low in the market, goes on to form a break of the previous external range and go on to form this external higher high and the new range over here, we have found a very important point in the market, a point of interest we call a decisional. So just for your understanding, here's a definition on the screen. The area that leads to the break of structure, the internal low, where this higher low in the markets goes on to make the new impulse a new higher high, and it breaks past the previous internal high and external high of the previous higher high in the external market structure range. This area that is responsible for the break of structure is called a decisional. So for your own learning, just take a screenshot, write it down in your notes so you know exactly how to define a decisional point of interest. Now we have well-defined bullish market structure, the trend, the points of interest, internal structure aligned with it, with the impulses, impulse number 1, impulse number 2. So we've collected everything together. Now let's break down how you effectively counter this trend. So once the higher high in the market has been taken, maybe we come to a higher time frame supply zone on the left. Maybe we do a major inducement. Maybe we take liquidity on the left. Or maybe we just form a high in the market that forms now an internal trend. So when we see this retracement, this is not meaningful because this could continue on to make a higher high, that internal bullish structure. So when we see that this actually respects the external high and makes an internal lower high that goes on to make an internal lower low. This is where things get interesting, because this internal high in the market goes on to form an internal low in the market, respecting the external high. You're probably already familiar if you watched the market structure guide and understood the market structure cycle, which is impulse, internal break of structure, complex pullback, efficiency of the pullback, new impulse. This is a cycle of market structure and how it goes from trend to counter trend retracement to new impulse in the market. It's a repeating cycle. And this is the building blocks where we have an impulse in the market. This impulse number 2 forms a higher high. Once this higher high is formed, looking at this definition I wrote, when the high high is formed, maybe hits a supply, maybe induces, and forms an internal high, which is a lower high respecting the previous external high, so it's lower, and also breaks this internal low to go and form an internal lower low, forming our internal range. This bearish movement internally is the beginning of an internal trend known as the complex pullback, whereas maintaining the external high, maintaining the higher high, and forming internal bearish trend. Once again, you can take a screenshot of this definition for your own learning, but this is the internal break of structure in the structure cycle component to begin the complex pullback. Okay, so for the pro trend scenario, we know exactly where our demand areas are. This decisional that we just defined that is responsible for the break of structure, and then the origination point, the last higher low in the market that broke the previous higher high to make a new higher high in the market, known as impulse number 2. So when we have these two areas of interest, our decisional demand and our extreme, these are all inside the impulse number 2 external high and external low range. And we're going to be reading the price action with the internal trend. So once we have two legs of bearish structure, where we have a pullback in the market, a fail to make a higher high, so it's a lower high, and goes on to make an internal lower low, we've established a bearish trend. Now, we can follow this bearish trend all the way down to the efficiency of the pullback, and this will be the complete complex pullback that becomes liquidity into a decisional or extreme area. So that gives us now a signal to say we can now start selling in this clearly bullish market. We can start selling this internal trend into one of these demand areas. Once one of these demand areas is met, we can start to anticipate a new impulse in the market, impulse number 3, which is with the trend going from higher low to higher high, retracing back to the decisional, let's say, and then making a new higher high bullish with the trend making impulse number 3. But this gives us an opportunity to potentially retracement sell into that demand, counter trend sell. And remember, we are looking for the most probable portions. We're not looking for the entire bullish move or the entire bearish move. We're looking for pockets of probability. And those pockets of probability, it could be this portion over here. It could be this portion over here. It could be a portion around here. There are many pockets of probability based on inducements, based on lower time frame confirmation, based on time window, based on daily cycle variations. All the guides I've shown in this channel, you combine them together to connect high probability setups. And these high probability setups are not bound by higher time frame trend. This is what I'm trying to explain. We know now what is pro trend. We can also start to see what is counter trend, and we can start to see that there's building blocks of what is confidence in probability, because now we know that we've established an internal trend. We can start selling this internal trend all the way down to the efficiency of the pullback in this demand area before we say we're no longer selling, because now the trend of bullish, the pro trend move, is now more likely to happen. In this portion over here, the bearish portion, the complex pullback, selling is more likely than buying, even though it's a bullish market. And then when we arrive to a demand area, then buying is more likely with the trend. So pockets of probability is what matters, not overall trend and only buying in a bullish market. And you know the best part is, if we can see that price comes into the decision of demand, and instead of making the new higher high, just like we said, it gives a bullish reaction, but then gives a build up over here, an inducement and bearish reaction, we can continue the complex pullback down to the extreme. So we have multiple opportunities to sell, where we could have our pockets of probability to sell over here, we could have it over here, and then we might have a probability to buy over here, and we take it because it's coming off the decisional. We see the inducement invalidates the buy, so then we look to sell over here, maybe a continuation sell. And then once we arrive to the decisional demand again, then we say, okay, back to the impulse number 3 to make a higher high. But we see we're finding pockets of probability, and it navigates and changes based on points of interest, based on inducements, based on internal and external trend. So we layer it all together to find the most probable counter trend scenarios. So the building blocks we really need to see is, after this internal trend of first area failing to make a higher high, going on to make the internal low, an internal lower high, and internal lower low. Once we establish that bearish trend, the complex pullback that's retracing back to one of our demand levels is defined by leg number 1, leg number 2. Once two legs of bearish structure are formed, so now we're establishing our counter trend trading range. And we can start to see that. Now let's zoom in. Once we had those two legs of structure, we're developing trading ranges now, because now we have an internal high that makes an internal low in the markets. That becomes our counter trend trading range. And now we see that once we've had two legs, that third leg we can start to trade. That third leg becomes a nice high probable setup to potentially sell, especially if there's an inducement over here that goes on to make this lower low. And then when we come back to this supply inducement level, we also have another inducement within here, with time window, with lower time frame confirmation, the trinity we speak about. Now we found the internal high supply zone. So now we're actually connecting a lot of dots together, because after a retracement number 1 and retracement number 2, 2 legs of bearish structure, if leg number 2 that forms the internal lower low has a inducement inside of it, now we have found a counter trend trading range. As we know, we want to be trading in premium. So we want to be trading, we pull a Fibonacci and we say, I want to be trading above the 50% from the internal high to the internal low. That second leg of bearish structure, I want to be selling above the 50%, ideally in this inducement supply. In that inducement supply, once price arrives here after doing a bullish move to this supply zone, if in this supply zone I get another inducement, time window, and lower time frame confirmation, I can sell it down to making a new lower low. So then we get impulse number 3. But not only that, not only do we get impulse number 3, we know we have clear targets, because when we zoom out, we can say, well, price has the potential to go all the way down to this demand area. Now, I'm only focused on high probability, high risk to reward portions of the move, not the entire move. So I might be in and out over here. But the potential is after impulse number 3, you can now do the same thing again. You pull another Fibonacci from impulse number 3 high to impulse 3 number low. And now if that has another inducement supply zone, a decisional and extreme, you can now look to sell once again of impulse number 3, and you go on to look for impulse number 4 after impulse number 3, all the way down the complex pullback until you arrive to a decisional area. So you're just going to be following the internal structure, which is bearish, with internal supply zones, with inducements in those supply zones and lower time frame confirmations. And you can trade after the second leg, the third leg, the fourth leg, however many legs there are, until we arrive to a demand area. Once we arrive to a demand area, yes, we expect buyers to take control and we get bullish price action. But if we get another inducement and another bearish push down, breaking an internal higher low that made the internal higher high, going on to make an internal lower low, a bearish break of structure after an inducement. Once we form that, we can continue to sell again. Bearish impulse number 5, bearish impulse number 6, until we arrive to our next extreme demand area. Once we arrived here, then we know we're back to bullish. But you can see how there are confident levels of bearish portions of the markets that are counter trend. In a bullish markets, we are going to be selling because we might find high probability in leg number 3 or leg number 4 until we arrive to the decisional. This is the framework. So what we do is we wait for the higher high in the market. Once the higher high is defined, we wait for 2 legs of internal bearish structure, an internal pullback, internal lower high, internal lower low. Once you have those 2 legs of bearish structure, you've now established the complex pullback. You can now sell the third leg, the fourth leg, as long as they have inducements, lower time frame confirmation, and time window, and you can sell all the way down to your demand area, the decisional and extreme. Once you have that, that is called the efficiency of the pullback, and you expect bullish market to take over. But you can confidently sell the complex pullback, which is counter trend. But if that counter trend complex pullback has lower time frame confirmation, time window, and inducement, these are high probability counter trend setups, and this is the framework. By the way, the reason I give all of my strategy and information away for free on this channel is because I believe information will empower you, it will give you clarity in the market, but it's probably not enough to make profits. Implementation is more important than information, which is why masterminds and coaching and consulting will always be more important than random pre-recorded courses. That's why inside of WWA, we're proud to present an invitation-only application process community where you'll get one-on-one personalized coaching every single week. You'll get daily live streams for London and New York session. You'll get multiple Q&A sessions per week, and with the dedicated coaches, they'll give you reports and feedback, check your journal, check your losses, and with access to me on Zoom calls, whether I'm live streaming a trade or breaking down your charts, there is a real personalized feedback to take concepts and theory into real market application for weeks and months on end. This really solidifies how to navigate the market, which is why we focus on $1 million funding inside our community. Think about it. $1 million in funding and 2% gain per month is life-changing money and more than a doctor's salary. If that sounds like something for you, click the link in the description. So now that we've got a good understanding of the building blocks of how to get a high probability trading range that is counter trend from leg 2 to leg 3 with the inducements and the protocol in place, let's break down in detail exactly in this portion from leg number 2 to leg number 3, the 2 bearish legs in a bullish market. How do we effectively trade them? Let's zoom in and see the protocol. So actually focusing in this area, let's take a closer look of what we need. Okay, now that we have a closer look, let's see the framework. So when we have impulse number 1, which is bearish, which fails to make a higher high, respects the external high, and goes on to make an internal lower high. That internal high forms retracement number 2, which goes on to form internal lower low. We are now respecting external high and internal high, and we're forming now impulse number 2. Once impulse number 2 is formed, that is our counter trend trading range. Impulse number 2 forms the high and low of that internal trend. Once we have that, then simply pull a fib from the internal high to the internal low. And then we see the 50% midline. We want to be selling above that portion, just as a quick guide. Once we are above that portion, we analyze further and we say the internal lower high that made the internal lower low, breaking structure of the previous low in the market, a bearish break of structure. Impulse number 2 had a buildup of liquidity. Once it had that buildup of liquidity, we did a inducement of the internal lower high to go and break structure and make the new internal lower low. So it's a buildup, inducement, bearish break of structure. Therefore, we know impulse number 2 is a inducement driven bearish impulse with a bearish break of structure. Build up, inducement, bearish break of structure, leaving a inducement supply zone. So let's write this out. We form that inducement lower high that goes on to make the internal lower low, a bearish impulse, impulse number 2, defining our counter trend trading range. And then we wait for above the 50% coming into that inducement supply zone. And once again, in that inducement supply zone, if we can see another buildup of liquidity, we see another inducement. We see this previous higher low making a lower low. So we have a break of structure. Now we get a inducement break of structure. If we get that bearish confirmation, that is an inducement off a supply zone in a key time window. This gives our entry protocol. So we can actually enter with all of these things to say entry over here, stop loss at that inducement high, targeting a new lower low, which will define our impulse number 3. So therefore, the range defined by impulse number 2, the counter trend trading range, we now look for impulse number 3 to form a new internal lower low in the market, and making this one a bearish break of structure. And therefore, the new internal high of the range becomes here, that inducement high, making this an internal lower high and making the new lower low the internal lower low. So now we are developing structure cycles, market structure, inducement cycles, and now we can actually effectively counter trend sell this complex pullback down to the efficiency of the pullback. And this is the step-by-step process. If impulse number 2 has an inducement and leads to a break of structure, then when we have the retracement to that inducement supply, we wait for a build-up, inducement, mitigation. We wait for a liquidity cycle, which is a lower time frame confirmation in the key time window on that supply zone, and we sell it down to a new lower low. This is a very high probability counter trend setup because we have all of the building blocks and we have a great target, which is the decisional demand, which we can continue to sell from. We can actually look for further opportunities where we have another build up potentially, we have another inducement, we have another break of structure, and we can keep selling down all the way to the efficiency of the pullback, which is in that demand area. So these inducement led opportunities that are the bearish portion until we arrive to the decisional demand, we could sell all of these portions, whether it's impulse number 3, whether it's impulse number 4, we could keep selling until we arrive to this demand area. That's when we can expect a new higher high in the market off that demand area. So bearish portions of the complex pullback into that demand area become actually high probability, high risk reward, high trade frequency, and high win rate opportunities that are based on structure cycle and inducement cycle. Everything that we need with the trinity of inducement, time window, lower time frame confirmation. Everything we speak about for years on this channel coming together for a very high probability setup. Now that we've built the building blocks, remember that was a zoom in on actually what was going on over here. So now that we have everything in one place, the full framework in action where we broke it down from the internal and external structure, and then we zoomed in to show you how to enter. Now let's take this framework and apply it to the market from recent price action. Okay, let's start on the daily time frame. A quick look. We can start to see that we had a previous bearish market defined by the red dots where we had a lower high that made a lower low. Once we had this build up, inducement, push out, breaking structure, and then mitigation, we started to form bullish price action. And then we started to have this bullish breakout. So we formed a bullish trend. From this lower low, we formed a higher high and we broke structure. So now that we entered a bullish market, we form higher lows and higher highs in the market. And when I look left and we see where is this higher high formed in the market, we see, okay, we haven't quite arrived to a supply zone yet. This supply zone is a great one because it was not only a build up, inducement, break of structure, daily refined IFC. So this becomes a great supply zone, but we see that supply zone has actually not been met yet. But we know that we've ran liquidity of previous highs, where this previous supply zone over here, this previous liquidity point in between this one and the one we're chasing now, the liquidity has been ran. So therefore we know price is breaking structure bullish, making a higher high and running liquidity. So let's zoom into this area a little bit further. So now quickly looking at the 4-hour time frame, we could start to see that yes, we had build up, inducement, bullish push out, mitigation with another minor inducement over here, bullish push out, retracement, bullish push out, retracement, bullish push out. So we're seeing clear bullish market structure and bullish trend. After we take this liquidity, we might start to see a retracement now into one of these demand areas over here. So let's take a closer look. Let's build the framework we were speaking about earlier. So now reading this market structure point, we can start to see this internal trend where we had this inducement because of this build up, inducement, push out, mitigation, goes on to make a internal higher high. Once we have, makes actually the external higher high. Now when we have this retracement, which has another build up, inducement, push out with another build up, inducement, push out, we start to get a new higher high in the market. So we've established from this low breaking structure to form a higher high in the market. And also remembering the higher time frame liquidity that we're taking. We're still having bullish price action led by market structure and inducement to form this higher high. Once we have that higher high in the market, we start to see things change because now we saw this inducement because we had a build up, inducement, push down, breaking structure over here. So that's our first leg of bearish. When we see that this retracement has an inducement and goes on to make a lower low, we can actually see our first leg and then we go on to form the second leg. So we can start to see we're actually having the exact building blocks where we had the break of structure to form this internal low. We're respecting the higher high, the external high, and also making an internal high, which is an inducement. And this goes on to make a new internal lower low. So we just had impulse number one, impulse number two is formed. And when we form a new internal lower low, that becomes a bearish break of structure, exactly as we spoke about. So now we can see we're getting exactly the building blocks we said, because now we have formed an internal high in the market that is respected. That internal high in the market is a supply zone and an inducement. And remember how we define the range. Once we've had the two legs, the second leg defines our counter trend trading range. Once we have the counter trend trading range, we pull a fib from the internal high to the internal lower low, and above the 50%, we want to be selling. Where do we want to be selling above the 50%? In a inducement supply. So we had a buildup of liquidity, an inducement that led to a lower low. And then when we arrived there, what do we need? Into that supply zone, we needed another buildup, another inducement over here, which basically forms our next supply zone. And what we are looking to do is now trade the next range down, which is to form leg number 3 of the complex pullback. And where will it be to? It will be to a decisional demand. A decisional demand will be our efficiency of the pullback because we know we can have a new impulse from here. And why is that important? Because we know from that decisional demand, we can now have a bullish impulse with the trend to form a higher high. So now we're getting the exact framework we spoke about. Everything we said from impulse, higher low, to higher high. Once we have the higher high in the market, we wait for one leg, two leg. That second leg is our counter trend trading range, which forms our internal high and internal low. As long as the external high is respected, we can sell this internal structure all the way down to a decisional or extreme, from which we expect a new bullish move to make a higher high. Inside that internal trend, leg number 2, it defines the range. Leg number 3 is what we trade. When we trade number 3, we want to be in the premium above the 50% fib. We want to be in an inducement supply zone and forming another inducement with lower time frame confirmation and time window. Now let's drop to the M1 now that we've done all the framework and see, can we find a sell with an inducement, time, and lower time frame confirmation? So we already showed how this is the internal high, and over on the left we have a build up. We have first touch, second touch, we form these equal highs, and then we have this inducement and break of structure. Once we have that inducement and bearish break of structure, we've now found a bearish impulse derived from an inducement. Within that bearish inducement, let's refine it and say, okay, inside that inducement there is the imbalance, and then I refine it and say, okay, is price now arriving to my imbalance in the key time window? We have inducement of the day potentially. So this is our inducement, this is our time window, the gray box, and I just need lower time frame confirmation. So for example, first leg, second leg, you can enter over here. A 2-leg protocol, stop loss over here is one entry type. Now this one is the one I wouldn't take for some other reasons. For example, Asia high, liquidity resting here. But this does become a nice trading opportunity where you can put your stop loss even at the high to be conservative, and you would take the trade all the way down as we were speaking. This is not the entry I would take. I would actually do a divergence based entry, a little bit advanced. But when I see that GU has actually swept Asia high in the London key window, now I know I have my Asia high sweep, which is a good sign that we are finding the inducement of the day. So this is potentially inducement of the day. EU didn't sweep Asia high, GU did. So this is showcasing me divergence and inducements. And then when I notice that here we are forming lower highs and on GU we're forming higher highs. So when I see this temporary divergence where one is forming a lower high, another one is forming a higher high, I know that I'm likely getting a divergence, which is an inducement, and therefore I can start to trade this area. When I really lock in that divergence and I see the internal break of structure, this becomes a selling opportunity right here. When I see this refined IFC, stop loss at the high to be very conservative, divergence based entry based on this internal break of structure and divergence, and then I know I can target immediately this trend line liquidity. Perfect. 1 touch, 2 touch, 3 touch, becomes great trend line liquidity. I always take profit at 1 to 3 risk to reward. And then TP number 2, always at 1 to 10 based on my data. If you want to understand that better, why I do these fixed TP levels based on a large sample size, meta-analysis of data of trades I actually took, go look at the profit taking blueprint that is also in the description, where you have a full breakdown free for you to grab with a video explanation, case studies and chart example based statistically and mathematically why you should be taking profits at these levels. The blueprint is yours. I don't want everything from you. Go download it. But getting to the point, TP number 2 is 1 to 10. So with this divergence and internal break of structure, I have my trade locked and loaded. And now I have a great counter trend position. And now I look and say, okay, I want to sell. My TP2 is the probable portion, but it's not even breaking structure yet. It's not even breaking the internal low. So I'm looking for a probable portion, not the entire impulse number 3 all the way down. I'm looking for probable portions, in this case, in a clear bullish market where we're forming higher low to higher high, retracement to go on to make a new higher high. I'm going to be selling the counter trend portion with high probability, and it becomes a tap and go opportunity. TP1, retracement, and then TP number 2. So this becomes a perfect trade, nicely played out, easy on your psychology. TP number 1 over here and TP number 2 at 1 to 10 over here. A lovely trade following the blueprints we speak about. And then like clockwork, price comes to the decisional demand, this inducement demand area that formed the break of structure, forming this higher high in the market. Price does the complex pullback down, comes into that demand area and taps it perfectly in the key window to have that retracement, potentially to now make a higher high. This is how you trade counter trend trading. This is a profitable approach. And there's a lot of things in this video that we probably covered. So make sure you watch the playlist that I've linked in the description, where you can actually see all of the guides, all of the case studies that are most relevant. Because if you're a little bit confused or you want to refresh yourself on the market structure guide, the POI guide, the inducement guide, the smart money trap guide, there's so many guides, so many case studies. Take your time, go down the rabbit hole of learning and go through this channel multiple times. Everything is here that you need. But most importantly, for real profitability, you need to know that a restricted trader is a profitable trader.